All right, let's talk markets with Rohit Agarwal then from Kotak Mahindra Life Insurance joining us right here on the show. Rohit, good afternoon and welcome on board. You seem to be positive from the short to medium term on the markets. What's keeping you upbeat? Is it a good earnings season that lies ahead, or is it the likely outcome of elections? What are the triggers that you think are sort of or likely to going forward lend support to the markets?
Hi, good afternoon. As you rightly said, that we are positive from a medium to long-term perspective. But from a very short-term perspective, we believe that we have to brace ourselves for some kind of a slowdown. And I'm not talking about the global slowdown fears which have started because of the inverted yield curve and people talking about how long when the next recession hits us. If we actually look at some of the data that is coming through in India itself, I think there's already some kind of slowdown. If you look at the data for the past 3 odd months or 6 months for say two-wheelers, for four-wheelers, and now when we speak to some of the top FMCG companies, they all have started to suggest that there is some kind of slowdown. There may be many reasons that one may want to ascribe to it, starting with the whole IMFS thing in September or just before the Diwali season, which was the peak festival season, which led to a credit freeze. To some may blame it on compliance cost or upgradation cost or safety norms hitting in the auto sector. And now some kind of slowdown in the consumer staples category also is something that we are witnessing, or at least the companies have started to tell us. It may also be to do with the effects of the pay commission waning off, or it's a multitude of all these factors. But the reality is that the Indian economy already has started to slow down, and we don't need that confirmation coming from the US or the Eurozone or Japan to tell us that things are slowing down. So from a medium to long term perspective, we obviously remain very optimistic. But from a very short term perspective, say next 3 to 6 months to 9 months, I believe that we will have to recalibrate our growth expectations to more like 6.5 rather than 6.5 to 7.5, which most people are projecting.
Hi Rohit, Nayantara here from the New Delhi studio. But the bigger question, of course, is also being on the global front. We need to talk about that. So while, back home, you got this whole queue on elections, which is the only thing that perhaps matters till May 23rd. Having said that, look what's happening in the bond markets today. For the first time, you've seen an inversion since 2007. That is pre-Lehman Brothers. It's pre the global crisis, the worst global financial crisis ever that we've gone through. So having said that, are you expecting a rub-off effect on the Lal streak to stay? The rupee has started outperforming, is doing much better than the Asian currencies. It has lost ground. It has gained lost ground. So having said that, the export-oriented stocks, for example, could they make a comeback?
Well, it depends on a host of factors. The inverted yield curve, which most people are talking about, which is a leading indicator of recession, as people say that bond markets are a leading indicator for the equity markets. If I were to believe that, and the globe at large starts to slow down because of the tax effects now waning off in the US, Eurozone having its own issues, Japan being there for quite some time, what it means is that the global GDP will slow down. And as you rightly pointed out, that would also mean that some of the emerging market currencies will start to hold up or look better. But we must not forget that when the world starts to slow down, we will still grow at a healthy pace, but will not grow at 8%. We'll likely grow at more like 6 to 6.5, and not 7.5, 8 that we are mentally attuned to. So if the world GDP starts to slow down at the margin, we will also slow down. Our exports will actually slow down. Some of the export-oriented sectors will likely, with the lag of 2 or 3 quarters, likely to see some contraction, or rather slow order booking than what we had envisaged or put in our models going into the future. On the flip side, if there is a slowdown in the world, the commodity prices should be in check, which is advantage for a country like India, which is so much dependent on oil. So if you put oil prices of say 60 to 70, more at the lower end of that 60, then we have a favorable Indian demographic environment where oil prices are low. The currency has less pressure because the dollar depreciates itself because of low growth in the US. But at the same time, the Indian economy itself will not do that well because the export-oriented sectors will also suffer. So I think that then you will need a boost in terms of either very sharp rate cuts, which can only come with good monsoon and lower inflation. See, as you see today, most of the projections on the inflation side are actually hitting the lower band, and growth also at the margin is actually at the lower side. But if we don't have a good or a normal monsoon, it's very likely that the growth tapers off, but inflation starts to inch up. Now, we don't want that scenario because that's not ideal for us. So the ideal scenario would be, being an optimist, which is that we have good monsoons or relatively all right monsoons and inflation remains benign. In that case, when global commodity prices are also low, then it opens up significant room for rate cuts to propel the growth story of the Indian markets.
Let's talk a bit about the sectors as well. Now, you saying that credit-linked consumption is already witnessing a slowdown. Of course, we all are sort of aware with the situation on ground. There was the NBFC crisis which played out, impacting the consumption sentiment, which may be related to sectors directly or indirectly related to credit and so on and so forth. But why are you expecting non-credit-linked consumption to witness a slowdown? Are you referring to themes like FMCG, or are there more sectors that you are a bit cautious about at this point of time, which are non-credit linked, and why?
See, the credit linked sectors which saw a slowdown were just after the whole NBFC issue, which is when the funding got blocked to them. So that had a direct effect on consumption. Now, a four-wheeler, which is 80% or 90% of those four-wheelers in India are financed by the banking system. When that system stopped financing them, there was obviously going to be a demand slowdown. But what happens is, if there is a likelihood or you see that your incomes are not growing as much as envisaged or the buoyancy is not there, slowly but surely from the discretionary side, it starts to seep into some of the FMCG / staples as well. It's not that they will degrow, it's not that the growth will come down at a very alarming level, but at the margin, there things have started to slow down. Now, if we actually talk to companies, which we keep doing regularly, they seem to suggest that actually rural is still holding all right, and it's actually the urban and the semi-urban which has started to show some kind of softness on the staples / FMCG side. We think it is very difficult to pinpoint what is the exact reason, but it may just be to do with the waning effects of the pay commission, where we got a boost in consumption from the pay commission hike. We also saw a boost in consumption because of various rates being slashed in the GST, and now after a few quarters, we are seeing that demand tapering off. It's almost the same in the US, where the tax cuts led to better earnings and GDP growth, and now people are expecting that it will wane off. It's a little different in India, but the effect is probably the same.
Okay, Rohit, always a pleasure chatting with you. We're going to leave it at that and look forward to more conversations like this on other editions of Markets at Lunch.